Hello, welcome back to the 5 in 20, where we cover 5 topics in 20 minutes. Today, I have Matthews Barnett with me. Hey, Matthews.
How's it going?
Doing good. We are broadcasting today from the Wiser conference room. We got kicked out of our new space. So hopefully, when we get back in there, we'll have officially everything done. Unfortunately, we're still going to have not a whole lot of furniture because of the shortage. I'm not sure what that's about, but... Well, I know what that's about. It's just frustrating.
We talked about it a lot. There's a lot of supply chain shortages.
So let's hit up topic number 1, DeFi100 Corruption. Matthews, I have been following cryptocurrency for a little while now. I have to admit, I was not a follower of DeFi, DEFI 100.
Yeah, so DeFi is just another one of those random cryptocurrencies. It's actually even less regulated than Bitcoin, the other ones that are still, somewhat server-based. This is just kind of the Wild West. It's out there. It's really not regulated. So there's a lot of talk or whether there's sketchy things going on with it, how you regulate it, and what exactly is entailed of it, because it's really just like a Ponzi scheme, it sounds like. The more people invest, the more the fund does well, and then it grows. So what this company did is they got about $32 million in investments. And then all of a sudden, people try to log in their accounts and went to their website, and it basically just said, sorry, this was a big scam, Ponzi scheme. We've got all your money. Sorry. Should have learned more about the company. Of course, that was a huge issue, and then the company came out and said they got hacked. But it's kind of tough to tell whether they actually did get hacked or if that we've talked about things being hacked in the last segment. This becomes a big issue with people being hacked.
If they were hacked, the website's not back up and running. So it could be that it was basically a Ponzi scheme, which I'm unclear as to what the ramifications are for the investors. I don't think that there are any. This is a very unregulated industry. They didn't buy it from an institution. This is something they just did online. So it's a reminder to me that when you start messing with these different types of currencies, digital currencies, I should say, you have to be careful.
Yeah, besides the Bitcoin, Ethereum, and a few other ones that you know very well, there's these other ones that are coming out that sound neat and might potentially promise these gains, but they're pretty unregulated right now.
Its first Twitter posting was December of 2020, so I guess that's safe to say, or at least that's a reflection that it was a very new currency. Where you think about Dogecoin, that's been in the news and has had entire Saturday Night Live episodes created about it. It's actually been around a long time.
Yeah, they've been around for over a decade.
So people say, well, Dogecoin has no purpose. It was created as a joke, but at least it has more staying power than some of these others that we're seeing now. But yeah, I don't know if you're totally safe in Bitcoin, honestly. I don't think it's definitely not a Ponzi scheme, but you see the price fluctuations here recently. It's definitely not a situation where you can say that it's a gold alternative or a cash alternative at this point with how much volatility it has.
No, especially these. It says it's built on a Binance Smart Chain, which is an independent blockchain. The whole purpose of this is they develop over 600 digital assets, Pancake Swap, Ellipsis, and others. I don't know what those are, but the whole point is it's developing more cryptos. So I guess you buy into the fact that there's some opportunity there, but you better know what you're talking about.
Right. Let's talk about movies for a minute. Have you heard of the James Bond series?
I think I have.
Rocky, Legally Blonde.
It's a little different than those.
12 Angry Men, Silence of the Lambs, Tomb Raider, RoboCop. All these are going to be owned by Amazon.
Shocker.
How do you feel about that?
I saw actually a funny meme about that. It had Bezos' face inside the MGM lion, kind of looking around. It's kind of how he is right now, just kind of dominating not just the world with the ease that you can buy things, but now they're acquiring companies like MGM, and they'll be starting the new Bond movies and whatever else starts to come out in the future.
I mean, they gives them a very large footprint now in a space that they sort of had it over the last few years, but nothing legacy like.
No, I mean, Amazon Prime, you could buy kind of competing with Hulu's and those things where they would have their own short series, as well as some random movies. But there weren't a ton of them, nothing huge like that would hit the big screen like this with some big historical names.
There's another shakeup in the industry as well. You've got streaming wars now. You look at content spending. Netflix spends $17 billion a year, and in content, Disney spending $14 to $16 billion a year. Now you have Discovery merging in with Warner Media. So basically, AT&T is spinning off Time Warner, that Time Warner purchase, which wasn't like $85 billion or something like that. It was a really, really big purchase several years ago. Now is sending that over to a new company, which would be Warner Media Discovery, which I think there's going to be a new name for it. But they're expected to spend $20 billion in production with the combination of them.
Yeah, Discovery is going to own about 29% of this company. Already, currently, AT&T owns CNN, HBO, Warner. The whole point of this is, like we just said, streaming wars. They're trying to compete with the Disneys and the Netflix. So there's probably some more acquisitions like this coming along, but everybody's trying to one-up each other here.
It's going to be interesting to see who wins this and who loses this, or is it everyone wins and they just win in different varieties? Because these are really large companies. I think a lot of it has probably had a lot to do with the pandemic to help push these mergers together.
It'll be interesting to see how this works out for the movies. Already streaming was kind of getting ahead of its time during the pandemic, with people being able to watch movies that came out on theater. Private movies were starting to get made that didn't even come on the theater, and then now these big companies are doing this. There might not be a need for theaters in the future.
So all that's fine, but from a finance perspective, I find it interesting and concerning somewhat that AT&T, in the process of all this, is going to be cutting their dividend. Have you seen what percentage?
One of the articles I saw said half, so they haven't actually done it, but they've announced it could be up to half, which I think
explains the stock sell-off.
Right.
It was half.
I think they've paid it for over 34 years or something like that.
So, you have what they call dividend aristocrats. First of all, AT&T shares have fallen more than 20% in 5 years. The last 5 years on any good stock has been much better than the negative 20% rate of return. So they're already having problems, obviously. But you look at GE and what they went through. They had to sell off some profitable things in order to cover their insurmountable debt. Part of my concern is with AT&T has been for years they have this great dividend. It's a 6.9% dividend, but there's a reason for that, and they're carrying just tons and tons of debt on their balance sheet. So I wonder if the Time Warner thing is going to help shore up that. But obviously, it had a cut in the revenue, which is why they're going to have to cut their dividend.
Yeah, you wonder if this was a play to actually get ahead of their times and start getting ahead of the streaming, or if they really was kind of a necessity with the amount of debt that they're carrying. You mentioned GE. A lot of that was due to their long-term care policies that they had to spin off. But yeah, you kind of wonder exactly how why they were carrying this much debt.
Again, I think it's a good example of why we buy index funds and why we avoid individual stocks. But if you're an AT&T shareholder, I would be concerned. Long term, is that something that I want to own in my portfolio? They just don't seem to be making the best decisions on behalf of their shareholders each year. And I'm not saying that Time Warner Media is a bad decision. I have no authority to say it is or isn't at this point. But certainly, when you have that big of a potential cut in dividend, it kind of makes you wonder what else is under the radar a little bit that could be damaging going forward.
Yeah, I mean, you're not only buying it for the dividend, but also a quality company. And if cutting the dividend in half, and then you think it's not a quality company, and the value could significantly drop, that's not a very good investment moving forward.
So we talk about inflation. I think that shows up on every 5 and 20 now, because that's what it's all in the papers. It's all in the media. What is inflation where is inflation coming from? There's a Wall Street Journal article last week about inflation hitting auto and home insurance prices. Now we have to remember that during the pandemic, auto and home insurance prices, especially auto, actually came down, because the less people drive, the less accidents are going to be, correct? So therefore, if more people are driving, then more people are probably texting and driving and eating and driving and doing all the things they shouldn't be doing behind the wheel. that means your insurance rates are going to go back up. So this time they're saying, well, inflation is hitting auto and home insurance prices, which is very true. But I think as consumers, we have to understand that we should expect higher premiums because more people are driving. There's more hazards on the road than there were a year ago.
Yeah, and another part of this is kind of overlooked. It was talking about, there is a global chip shortage, scarcity of rental cars currently, and then obviously the increased cost of lumber and other building materials that get backed up logistically right now. So that's actually going into the cost of, when you're having claims and replacing something or repairing it, that's kind of getting priced into what's happening with these claims now. So that's another part of it you wouldn't really see usually.
No, very true. Next topic we want to cover is the Olympics. So this is interesting that, we are opening up here in the U.S., but if you look around the world, Japan, India, it would be the worst case scenario, I guess, right now. They're still struggling to get people vaccinated, and they're also struggling with people just having the virus. So now we're looking at polls of people in Japan. Overwhelming majority of Japanese residents don't want the Olympics to happen. I don't know if they have any say, but it seems to me that we may not get the Olympics this year.
Yeah, I mean, SoftBank's CEO is one of the biggest proponents of trying to have it canceled. But, I mean, you got to think this is a global event. So it's not, like you said, a lot of Americans are now vaccinated and we're controlling it right now. But around the world, they're not. And when you get everybody in one place around globally, that could become an issue. And I think Japanese leaders are kind of just worried about, as much as this does for their country, also could it be, detrimental.
Well, it definitely brings a lot of revenue to the countries when you have that many people coming in and filling up hotel rooms. But I kind of wonder if do you have the same effect if you run the Olympics and there's no spectators? Because they're already saying they wouldn't allow foreigners to come in and view. So at that point, I don't know that you're getting all that money going into your economy. So I don't know. I guess I'm kind of indifferent to it in the end. I don't live going, oh my gosh, I can't wait for the Olympics. Like I feel like I can't wait for football season.
Yeah.
Or a baseball season, right? Or the Masters.
Well, you mentioned the Masters. I mean, Dustin Johnson's not playing again in the Olympics. There's still people, whether it has to do with coronavirus or just not wanting to play in the Olympics. The Olympics is more of an amateur deal. That's a big event for them. But some of these guys get paid so much money now, they don't really get paid a lot. It's more for just representing their country. And a lot of times, I feel like it's not that big of a deal anymore for certain sports.
Yeah, well, I don't want to downplay the Olympics. That wasn't the intent of putting in the 5 and 20, but certainly I think the economic benefit of the Olympics, it almost seems like the cost is higher than the benefit at this point if you're not allowing viewers at the – and imagine, people doing the 100-yard dash and there's no one cheering them on. They're just out there running, right? And they're also talking about athletes. When you usually have the Olympic Village, and the athletes are there for the duration of the Olympics. They have the Olympic experience. Now they're talking about you could come in 4 days prior to your event, and then you must leave immediately following the event. So it kind of takes away the world coming together to compete is partially what it's about, right? But we're not. The world's more like it's coming in from a long-term party to a drop-in party.
Yeah,
you have to drop in, and you have to leave.
It's not the camaraderie or hanging out, meeting people from all over the world. They're not going to have that experience, and that has to be weird too, where they thrive off of people cheering for them, and it's more like a practice at that point.
So anyway, it's something to watch. Wall Street Journal seems to be covering it well. So the last thing on our 5 and 20 is no more cold calling. At least from one broker. Are you following this?
I have actually looked at it because I've been there before, actually, down this road where you would unfortunately have to do Tuesday night calls for 2 hours and randomly pick a list of people and cold call. Wasn't very productive at all. And what happened was, besides the unproductivity of it, is the fact that they were calling people on the do not call list. As well as other people at that broker-dealer that already had a relationship or claimed they had a relationship. So that ends up becoming an issue. So they've announced that there's no more cold calling, but in order to replace that
who's they? They is, Bank of America says it's just Merrill Lynch. So
correct.
You might get a phone call from UBS or somebody like that, but a Merrill Lynch person won't be calling you on the phone anymore.
Correct.
And so you should go back and tell people how this works. I mean, some people might actually know this, or maybe they're on the other end of it. But you basically you get a job as an advisor at a lot of the big box firms, and your first victims are your friends and family, right? So they're the first ones that you contact. Hey, I've started this new career. This is what I'm doing. Then when you run out of those, the boss looks at you and says, hey, here is the phone book, essentially, or a list of names that we purchased in this zip code in this neighborhood. And you literally have to start calling those people one at a time, right?
It used to be called the Rolodex, and you'd have people come show you actually cards. They would just go through decks. But, yeah, what they would hand out recently was more just a list of people in the area. You'd try to reach out to them or get through, the controller comp at the office and try to make an introduction and establish a line of communication. Very difficult and not that fun.
I remember I'm having chills and some anxiety just talking about this. I mean, I remember sitting in a cubicle for my first year in the business, and they saying, you got to call these people. And I'm like, I'm not calling those people. Those people don't want to hear from me. I remember making my first call, and the guy was like grumpy and basically hung up on me. And the guy in the cubicle next to me happened to be pretty good at it. He called that guy back. He goes, hey, why are you so rude to this guy? Didn't know I was even more devastated that I had like, big brother over here trying to help me make a cold call. I'm not built for that. And you will never get a cold call. No one will ever get a cold call from Wiser Wealth Management. That is definitely beneath us. but yeah, the horror is still there and having to do that. And I think I did that for maybe 2 nights. And then I was like, no more. I'm not doing this anymore.
That's what the wirehouses, though, like the Merrills, are built on. Besides referral based, is cold calling, and now they're not going to allow this. Their approach now was, they said, LinkedIn direct messages. I don't know how effective that is.
That's kind of our buyer beware. So now your phone won't ring from Merrill Lynch. However, your LinkedIn inbox is going to be lit up from people reaching out to you if you're of a certain demographic. So yeah. So what does that do to LinkedIn now? Does that make people go, I don't know. I feel like they're late to the game. I get emails all the time from people who want to help us with marketing, or they want to write articles for us, or they want to write, do different things. So I guess I'm sort of used to solicitations. I very rarely do I ever get the, hey, I want to get to know more about you and your company because I need a financial plan. I don't really get that from LinkedIn that much. It's really more professional, business-to-business solicitations.
And most of the time you look at them and you're not responding, there's no relevance. So I just think that's going to be an issue for advisors trying to reach out to a person of wealth that's prominent, just trying to make a random introduction without some type of connection there besides LinkedIn connections.
Well, they had to give them some out. I mean, the company had to give them some opportunity to say, okay, this is how you can reach out to other people. But I don't know. It's obviously I'm very biased because what we're doing, or what they're doing, is taking annuity and product sales off of cold call, and now they're going to start soliciting people directly on LinkedIn to buy the same crappy products. And they're not working as a fiduciary. They're literally, this is just proof that they're out there to sell product. They're not out there to give advice. They're out there to sell product.
Yeah, well, they sell less of product to that firm and more now of investment management, but it's still kind of a solicitation of services like that. What they're end up doing is they're going to get a lot of referrals from the bank side of things. So that'll probably be what it ends up, less of direct LinkedIn, since you can't call, and they'll develop a way to have more referrals directly from the bank sources.
I don't know. Just say no. All right, Matthews.
Enjoyed it.
See you
Thank you.
next time.